there's only two things, but each of those probably takes quite a while. First, you got to decide what price you're happy to buy in at, and then compare that to what the price is today to determine what the upside is. And that's the process going to take you a long time, but it's relatively simple. You might really like the company, you might not really like the price, and vice versa. Sometimes you might want to invest in a company you don't particularly like, but you think it's very undervalued, and therefore you feel there's an upside in there. And then the second thing is you've got to know when you're going to sell, because that could happen in 2 months or in 3 months. It could happen in 10 years. You don't know. And again, that's going to be driven by your valuation. And the way you would value a business is if you were like a lot of people, when they invest in stocks, they don't treat it like they're buying a business, but that is exactly what you're doing. You're buying a small share of business. But let's say you're buying the whole thing, like you're buying a corner shop. You would want to go through the books. You would want to go and see exactly how those books have changed over time. What are the different trends in the local area? What is the demand for the types of products that the corner shop sells? Is there stuff that the corner shop does not sell but could be selling, where there's a potential upside that is not yet being materialized? Is there a general regeneration in the area? Is there actually something happening in the city where long term there's a potential less footfall that's going to be hitting? You should do all these same things with investing in a company, because you're becoming a part owner of that business. So you would want to go and build a valuation model, and valuation model can come in very different guises. I tried to do a bit more work by building a bottom-up model where you would take each single part of the business, each business line, each single revenue stream the company has, and try to figure out how that revenue stream is being generated. What are the drivers of that? Is it, selling a particular service? What is the monthly price for the different options? What is the propensity for that price to change over time? What is the propensity for people to buy the various different products that the company sells? How's that going to change in the future? And basically model all of those different things out, and then just add them up to figure out what the overall business metric is going to be, because each of those business lines will have its own cost base. The overall business will have its general costs. It will have its marketing costs. Like how do those marketing costs relate to the number of people who will be buying the products? Is there a performance marketing budget that directly brings people in? Is there a general brand marketing budget that they're always going to be spending? How is that going to change over time as the company grows? So
real simple.
Real simple.
Two simple steps.
Just knock it together.
I think people need to rethink investing in many, many, many cases out of what I see, because a lot of people do think it is really simple. And the fact is, it isn't, and that's why most people should not be investing. And it's very weird, because I do run an investing channel or financial management channel, and it probably very much goes against what I do. I'm making a course where I'm going to try to sell the analytics kind of like learning to people, but I'm saying that most people shouldn't be doing it, and that's because that's the case. Most people don't have the time to do it. Most people don't have the skills to do it. A lot of people are not very comfortable with just making a little basic table in Excel, let alone build a whole model in it, for example. And that's probably just the most basic version that you might build. You might want to build more sophisticated things to run scenarios, etc. Most people should probably steer clear if you're not prepared to do some version of that. Because if you're just basing your investing decisions off what you've heard from somebody else, even if you trust that person might have wildly different risk tolerance to you. They might have a wildly different situation. They might be happy to lose all their money because in a different scenario they will make a huge return. Their risk reward ratio is very different to yours. You might not be very happy at all losing all of your investments. It might be a life-changing amount of money to you. They might be earning a lot of money. You might not be earning a lot of money. So they're going to be just fine. You're not. So it's huge. You can't just listen to what somebody else is doing and copy what they're doing, because they're likely to be in a different situation to you. And if you don't do your own homework, what are you doing? You're just gambling. You found a stock, you found a ticker symbol, you found a price, it's $100. Like, how do you know if you should invest in it or not? Because some random guy on YouTube said so? I mean, smack yourself in the face.
Yeah.
It's just not the way to do it.
Yeah. These are the 2 steps that Sasha says you need to take to invest in individual stocks. Want to find out how many hours he spends doing that a year? Then just click right here.